Another question, given that our strategy from our strategies from their peaks have dropped anywhere from 60 to 80% since February of 21. So this has been almost 2 years. Why do we not turn defensive like most managers are doing? Well, there's a very important explanation for that. We do one thing. We do not pretend to be an asset allocator. We are our research and our investments are centered on disruptive innovation. And so when advisors and individuals choose our strategy, they're not choosing it alone. They have more diversified portfolios, of course, including real estate. The biggest asset most consumers have is housing. So we are one part of an investment portfolio, and therefore we would never be using cash. We would expect advisors and individuals to basically raise cash and segregate it from their investment portfolios. In terms of our strategies, we, during downturns, concentrate towards our highest conviction names. And so we have been doing that now for nearly 2 years. And the history would suggest that concentration strategy plays out very well in the subsequent rebounds. And we do think this rebound will be quite powerful. This year has been the most difficult year of my career, worse than 08-09, and I would venture to say that it has been the most difficult year of many investors' careers. The only thing that worked this year was energy. It's up almost 50%. And many people are asking us, why don't we diversify into energy since it's working? Well, the reason for that is we think it will stop working. If our forecasts for electric vehicles and autonomous taxi platforms are correct, then oil demand could drop by roughly 30%, 30 million barrels a day during the next 5 to 10 years. And we believe that demand destruction has already started. It looks like oil demand peaked in 2019, and we're still in the process of peaking out, I would say, in the 100 million barrels per day range. But we think the resolution of that basing period here is going to be down. So we wouldn't be investing in energy, and we think the indexes that have rebalanced and now are including more energy are mistaken, and those investments, that rebalancing will not work out. Now, another question. You have been buying more Tesla and other stocks during the downturn, and yet the prices have fallen further, and our performance decline has worsened. With interest rates and prices fluctuating so widely, and in this case they probably mean increasing, will an investment focus on innovation work? Well, we believe that the leading indicator, correctly, is inflation, and it has peaked. The inflation rate has peaked. Almost every measure of inflation has peaked. Most of those metrics peaking out in March or June of this year, in the first or the second quarter. So typically, that's a good thing for innovation. But as I just mentioned, I think the market is so skittish and has been so terrorized by the most rapid increase in interest rates ever. We have never seen an 18-fold increase in interest rates within 1 year. It has truly terrorized the markets. And I think that the fear is palpable. In fact, I think according to the Bank of America recent surveys of fund managers and advisors, it's probably the advisors, We haven't seen this amount of cash on the sidelines since I think it was 2006, maybe even 2001. I do know also the same survey shows that the put to call ratio in the US market, meaning those short relative to those long put calls, is at 1.5 now, and it has not been that high since 2001. So we have an incredible amount of fear in the market, and that actually is the best time to average into these markets. I remember in late 20, early 21, we could do no wrong. Anything we said was gospel at the time, and I knew that that wasn't right. And at the time, I remember saying, keep some powder dry. It is for these moments, or averaging down throughout a period like this, that one keeps the powder dry. This period seems to be the flip side of the late 90s. The late 90s was an irrational increase in tech stocks, appreciation in tech stocks. And it was incorrect. The technologies were not ready. And even if they were close to being ready, the costs were way too high. So technology's not ready. We didn't get the cloud till 2006. We didn't get the big breakthrough in AI, deep learning, until 2012. The cost for DNA sequencing, 2.7 billion for one genome back in 2003. That number is down to $500 now. We are ready for prime time, and yet investors are doing the opposite of what they did during the late 90s. They are running away, running for the hills, running for their benchmarks, and we think that innovation is going to pose a problem for the benchmark.